There we are.
Good morning. I'm Drew Davis with Davis Group CPAs. Appreciate the invite. Talk about some bookkeeping and taxes, kind of how it relates to the realtor field. I'll try not to take 30 minutes because talking taxes and accounting will put people to sleep, but just kind of hit the basics of, I guess, want people to, start thinking about ideas of make sure they're accounting for everything properly, and then maybe get a little bit of take a deeper dive into some taxes of, do we set up an LLC or S Corp? So I'll just kind of start with the basics of kind of how I like to see realtors. I know most people, I think everybody here is an independent contractor, and kind of see how that would play. First with some, blocking and tackling, make sure everybody has good record keeping. We like to see where realtors will have their own separate bank account to keep track of kind of the realtor related income in, expenses out. So if you don't have a separate bank account, that's something that we would like to see. Just specifically for if it ever gets to the IRS or NCDR, looks at a bank account, just so it doesn't look, personal expenses don't sneak in there, but just like to see separate bank account. Same thing with credit cards, separate credit card for realtor related expenses. So that's kind of how it starts, and then that'll lead into, okay, what are you doing for your bookkeeping? I know now we're getting into the boring stuff, but from a bookkeeping standpoint, okay, are you big enough? Do you have enough transactions where do you need some sort of bookkeeping software like QuickBooks or Xero? Or like most of my realtors, it's just simple enough. They have their own bank account, and they can go through at the end of the month and set up a little Excel spreadsheet to categorize the expenses. Just make sure they're tracking everything properly. So my advice there would be just try to keep it small, keep it simple. It doesn't have to be too exotic. Different things work for different people, but would recommend if you have enough transactions and you're kind of getting big enough, to look at maybe a QuickBooks Online or Xero, where you can link your accounting system to your bank account, just to reduce on some of the data entry and save you some time. But most, if you need to talk to an accountant or tax professional, most can help you get set up with something like that and help you get your chart of accounts set up and the basics. And again, keep it simple. It doesn't have to be this isn't rocket science. It's just tracking kind of the ins and outs of income and expenses. So with that said, kind of the basics of having a separate bank account, how are you keeping your records? We can talk about what's deductible. That's always popular questions. With the realtors, the obvious things come to mind with any sort of dues, licenses, phone, internet, any sort of education or training. Also meals, meeting with potential clients or customers. Now under the current tax law, entertainment is no longer deductible, but meals are deductible. With a little bit of a caveat there, they used to be last year, they were 100% deductible. Now this year and going forward, it's back to the traditional rule of 50% deductible. But other things to think about are if you buy a new phone, laptop. Also, the other ones to think about are home office deduction. Kind of the standard deduction for home office now is $1,500. But the way the home office works is kind of, is it worth your time to prorate what you have set aside as a office space and prorate your utilities and insurance. So something to take a look at, kind of what comes out ahead. To be honest with you, most people nowadays just take that kind of standard $1,500 home office deduction. But the last and probably the biggest one for realtors to think about is travel. So here, what I want people to understand is there's the simplicity of just tracking mileage versus is it worth tracking all the expenses and actual expenses and taking the cost of a vehicle and tracking that. So at the time you place an auto in service, as long as it's used for at least for 50% business purposes, you're able to depreciate that vehicle. Depreciation just means nothing more than I'm just going to use simple numbers. It's going to change a little bit, but let's just say you buy a vehicle for $20,000. You can depreciate that. You basically get a deduction over 5 years, kind of spread it out. Unless you do some bonus. Now it's getting technical with taxes on ways things can go, but just understand with a vehicle, you can't double dip with, I'm going to take actual expenses and mileage. It's kind of decision of, with that vehicle, I'm taking mileage or I'm taking the actual expenses. Typically what I see is most people just like the simplicity of mileage, nothing more than having your, with all these apps these days, you can track this stuff, or just the old school pen and paper. People just have a pad in the car. But the point there is just to track your starting location, ending location, the number of miles, and then the business purpose is all the IRS is wanting to see. So just have good record keeping there of tracking kind of where, tracking through your day of kind of where you went, who you met with, and the number of miles. So,
and question.
Sure.
So what about for people who have their vehicles stickered or lettered, or, they're advertising on that? Does that change that rule? Because I've heard yes and I've heard no.
Yeah, that really has nothing to do with it. Now any sort of cost of putting that on your vehicle would be a deduction. But as long as the vehicle is used for at least 50% business purposes, then you can depreciate the vehicle. Regardless if you use the vehicle, if it's used less than 50% for business purposes, you can still always track your mileage. So yeah, the sticker has really nothing to do with it. It's kind of what is the number of miles you drove in that year and the business purpose. I would guess 95% of realtors are using their vehicle the majority of time for business purposes. That's just kind of how I see it with how people are just kind of these days. It feels like life and business kind of blur. You're kind of always in business mode. So typically we're seeing where it's that we have the point there is you have the option of, do I depreciate or do I take the mileage? And back to typically people take mileage. I will say here with the last couple years of it's been a good run in the realty industry where some people have made some money, and the autos can be a good idea if you need to kind of front load a deduction. With the current tax laws, you can basically any sort of SUV or any auto that's over 6,000 pounds, you can kind of front load a deduction and get some big deductions there. The trade-off is you get the deduction up front and then kind of lose that depreciation on the backside. So if it's something you're thinking about, it's probably wise to maybe talk to a tax person just to kind of see, which way to go. Different people play it different ways. And I guess the point there is just kind of always maybe have a plan of kind of what you're wanting to do there.
Hey, Drew.
Yes.
Hey, I didn't know if I was muted or not. It's Paula. Can you do mileage and gas receipts?
No, you're not allowed to double dip. So that's what I was talking about. Yep. It's per vehicle. So if you were to get a new vehicle, you need to make the determination at that time. Am I going to use mileage or am I going to take the actual expenses?
Okay.
So when you're taking the actual expenses, that's where you would depreciate the value of the auto. If it's being fully used for business purposes, you would get 100%. If you're 90%, you did not. I mean, we're getting a little bit too technical here.
That's what I do. I've always done that because I'm terrible at tracking anything, especially mileage. So I've always done my gas receipts, and that's why I usually always get a car every 2 years, but it has to weigh over 6,000 pounds, guys, like he said, to get the biggest tax deduction.
Yep. And to that point, Paul, too, it's kind of whatever works. If you sit there, hey, I've got my credit card or I've got my debit card, and every time I'm swiping that to be able to track the actual expenses and just make it simpler, it makes it simpler. So some people, yeah, they might not forget the card, or they always, they have a bad habit of using the personal card. They just assume to track the mileage. So it's kind of there's one, the record keeping side of it, kind of what's simpler, and then there's the other side of it. Does it save you a little money? Yes or no? But to your point, you're not allowed to double dip. And with gas, if you ask me, kind of with gas prices have gone a little bit crazy here, I'm not sure the mileage rate has kept up enough of that. So there again, it's kind of something you need to have a little bit of a game plan, and sometimes it's a moving target. So
Drew,
yeah.
do you, to me, a vehicle has always been my biggest tax deduction. What, I don't even know how to ask this question, but at what point, number one, do you think an agent should consider purchasing a new vehicle to help them on their taxes?
Mhm.
And number two, how much do you feel that an agent should make every year before they go through the expense of opening an S Corp?
Okay. Two good questions. And man, my 30 minutes, I could talk for this for an hour now. Well, all right. It's kind of case by case. I guess there's no, I'm going to give you a good tax answer. It depends. It's each individual's kind of own scenario with the same, if they're married, are they filing together? The other spouse's income, are they, it's kind of, you need to look at the whole picture. Okay. And also at the same time, this is where to me, it's really important through the year to have an idea of kind of your income. I know with realtors and timing and when deals hit, it can be a roller coaster, but you really need to have an idea of kind of your income you're going to make. Let me give you an example. Let's say you're having a little bit of a down year, and hey, I might stick, after income and expenses out, and I'm going to make $30,000, $20,000. Going to buy that big SUV doesn't make much sense from a tax standpoint. Now, don't let the tax tail wag the dog, but there's not much tax benefit there. On the flip side, let's say you just have a blowout year and you're making over $100,000, and now you need that big lumpy deduction. That's where you could buy the SUV and front load that deduction to offset. So it's there. You need to kind of have an idea of it's all about having a game plan. Have a game plan of kind of what you're expecting your income to be. Keep an eye on it, and then sometimes you just have to read and react if income's up or down on kind of how to play things. So there is no just right or wrong answer. It's really dependent on each person's individual situation, not just from a realtor standpoint, but also kind of household income and kind of what's that tax deduction is really worth. To your second point about S corps, that's the most popular question when it comes to realtors. When is it the time to incorporate myself? So might be time to get the pillows out now as we're going to start our tax 101 lesson. I want people to understand, I guess this is where some confusion comes into, where people say, I'm going to set up my LLC. Does that make me an S corp? The answer is no. So by you just setting up an LLC, that is nothing more. It's really nothing for tax purposes. It is just a legal entity that's really the intent is to provide just some legal protection. But if you were to just go to the Secretary of State website and set up your LLC, there's really no difference for you being a single owner LLC as you just being a sole proprietor in your own name. What's a deduction in one's a deduction in the other. There really is no difference. The income will still be subject to self-employment tax. We're paying both income tax and self-employment tax. There is no difference. The difference becomes when you make what's called an S election with that LLC. The S election is basically saying now you have a separate entity for tax purposes that has to file and report its own income and expenses. And then that income or expense passes through to you at the individual. To really, when you do an S Corp, kind of think of it, you're wearing two hats. You are the business owner and you're also the employee. You will work for your own business. So think of it kind of right pocket, left pocket. There's no difference from an income tax perspective. The benefit is from a self-employment tax perspective. So let's kind of walk through an example. I'm going to use round numbers. These aren't exact, but I think it'll kind of give a little color to illustrate kind of what I'm talking about. Let's say you have a really good year and you're a sole proprietor, LLC, no LLC, it doesn't matter. And you make $100,000. Not only do you have to pay income tax, but you have to pay self-employment tax. So kind of think of it, if anybody's worked at a job with a W-2 where they're taking out FICA out of your paycheck, that's Social Security and Medicare. When you combine the two, what's taken out of a paycheck is 7.65%. The employer also has to match what's taken out of your check. So it's 15.3%. But let's just use for discussion purposes 15%. And I know there's some deductions and things, but I just want to use round numbers just to illustrate. So just for the illustration, we're just going to use an even 15%. So back to it, you made $100,000, and not only do you have to pay income tax, but you have to pay an additional 15 grand in self-employment tax. What people do is, this is where the S Corp can add some value, is now instead of being a sole proprietor, single member LLC, everything's subject to self-employment tax, you set up an S Corp. So let's use the same scenario in our S Corp of, I made $100,000, but then I'm going to pay my employee, myself, a wage of $50,000. Kind of think of it, it's right pocket, left pocket. You, the business owner, made 50. You, the employee, made 50. We still have $100,000 of income. There's really not much of a difference from income tax perspective there. It's income. The real savings comes from the self-employment tax. So you, as the business owner and the employee, you're still kind of paying both sides of it. But instead of having $100,000 subject to self-employment tax, now you have just that 50 that you paid yourself a wage. So in that, again, round numbers, and the mileage may vary here, but you just sit there and cut around a $15,000 self-employment tax bill in half by simply setting up the S Corp, paying yourself a wage, and removing that self-employment kind of anchor there, self-employment tax. So just from the sound of, oh, the S Corp's great, perfect. That's what I want to be. But also understand there's some trade-offs to the S Corp. There's the point there is there's going to be some compliance costs and extra paperwork. As I mentioned, the S Corp has to file its own separate tax return. So there is compliance costs there. You have to set up payroll. That includes setting up with IRS, North Carolina Department of Revenue, North Carolina Unemployment. You have to, fill out all that paperwork. And then same thing with, determining a wage. Most of my realtors, we try to get a little bit of a game plan together. I know, like I said, it's a roller coaster, but we sit there and show maybe a monthly wage. The point there is on the wage is try to keep things as simple as possible. But just understand there is a trade-off of extra compliance costs and paperwork with the S Corp that you wouldn't have to worry about with being a sole proprietor. So circling around to the original question, Paula, is kind of, when does it make sense? There again, it's a little bit different for everybody, but typically where I see it is in a range of $25,000 to $35,000. if after kind of income in, expenses out, I've taken my mileage, I've taken my home office, my income's less than $25,000, it might not make much sense to be an S corp, just with the compliance costs, and additional time and effort and paperwork. 25 to 35 is a little bit of a gray area. But then typically what we see is anybody that's making over $35,000 a year, it's probably time to flip the switch to an S corp. So, like I said, everybody's scenario is a little bit different, and some people might, view things differently and play the game a little bit differently. But just kind of understand that that's where most people, that what I see is kind of where they make the decision yes, no on the S corp. Also, you need to understand the S corp is not a switch that you can flip back and forth. It is kind of if we're going with an S corp, that's what we're going with. And typically the way I like to see it is if you're setting up an S corp or an LLC from day one, and your expectation of, hey, this is going to be my, this is how I'm going to make a living, and this is what I'm going to grow, and this is what I'm going to do. I say start with the S corp from day one, even if you might be below that threshold. On the flip side of that, also understand if you have an LLC and you haven't made an S election, you have until March 15th of every year to flip the switch. So let's say you had set up an S corp last year and it's now September and I'm having a boom year and I want to set up, I want to flip the switch to an S corp. Technically it'd be too late. We want to see it where it's done either from the start or, by March 15th of every year to make sure you're in compliance. So I saw the question kind of come through of, what's typical compliance costs. There again, I guess everybody's a little bit different. I'll kind of tell you how we do things, and that's not to say that our way is the best way, but we try to keep things simple and cost compliant. The cost of compliance down as much as we can. So typically, if you have some good bookkeeping and the records are clean, the preparation of an S corp tax return usually should run you between $600 to $750. And on the payroll, the way we do it is we have a setup fee for getting all the paperwork, setting up the paperwork for IRS, North Carolina Department of Revenue, filing the paperwork for an S corp, $300 to get you set up. And then on an annual basis of payroll should run you between $600 to $700 a year. So part of that with the payroll is you're using that payroll to also pay in the taxes. So you withhold your federal tax, state taxes through your payroll to kind of make sure you're covered for the year for taxes. So compliance costs, they can run, I guess, $1,500 to $2,000 is kind of a reasonable range you should be expecting, all in for the S corp compliance and filing your tax returns and individual tax returns.
Hey, Drew, I have a question.
Yep.
Also, before you sign off, will you give everyone your information, I guess, in a text box, so they'll have your information just in case they want to?
Sure. Let's see. I'll try to figure out how to do it. If not, you can shoot me an email. It's just drew@dgcpa.com, but I'll try to. These computers are great.
Melissa can probably do it.
What's that?
If you can't, Melissa probably can.
Okay. Sorry. Well, there you there. It's already been 30 minutes. Is there anything else? I know. I guess I kind of rushed through there at the end. But is there anything else with kind of the LLCs or S corps that you would?
One question, of course. Yeah. Do you have to have an LLC to have an S corp, or can you just have an S corp?
Well, good question. So you can have to be an S corp, you have to be an LLC or an Inc. So you either need to organize. I'm assuming everybody's in North Carolina. You need to organize file your articles of organization through the Secretary of State in North Carolina to be an LLC, or you incorporate through the Secretary of State in North Carolina to be an Inc. Either one of those can be an S corp. but you have to file, the process works. To be an S Corp is you would have to file paperwork with the Secretary of State, either LLC or Inc. And then when you get your tax identification number through the IRS, and then once you have your tax identification number, you can then file the paperwork to elect to be an S corporation. And from that point, you're ready to rock and roll.
Okay. Well, tell you the truth, I'm not sure what I am. But you're my
I'm not either.
accountant, so hopefully.
Well, I mean, it gets to the point. Starting off, I see a lot of realtors wanting to keep costs down, and which I completely understand. But there does get to a point of where your time and effort is better spent out in the field and kind of leaving it to a professional to kind of help you there. And once you get up to that, I'm making over 35,000, 50,000, 100,000 plus a year. To me, obviously, I'm a little biased. I think an accountant or somebody that kind of knows what they're doing is going to add some value there. That'll more than offset any sort of cost. And kind of the way we view it too is, from our perspective is, we want to be helping our clients, manage their cash flow, manage the taxes. And it's important to, back to the bookkeeping and having an idea of the income, where this time of the year, we try to start sitting down with people and just get a, year-end game plan of, here's our income right now. What do we think is coming in? Do we need to spend some money? Do we want to buy a laptop, buy a new phone? Do we need to buy the new auto? And at least give people the options of, what to do and have a game plan there. Because, some of this, we can start talking some real money. And, even if we're sitting there just saving, $1,500, $2,000 a year, year after year after year, that starts to add up. So, that's kind of my advice. If it's starting to get up there, it's probably time to talk to a CPA or an accountant that kind of knows what they're doing.
And I highly recommend Drew and his company because he helped me.
Well, I appreciate that, Paul. I guess the way I view it, it's not rocket science, but it's just,
It's for us because
I guess it is rocket science to you guys, but yeah, if you feel like you're getting overwhelmed, sometimes it's just take a step back, talk to somebody, just, like I said, understand the basics. And yeah, if you're making some money, it probably is time to talk to somebody and maybe set up that S corp.
All right. Does anyone have any questions for Drew? Which I think everyone's muted. So
Muted or they fell asleep. I'm not sure.
No, I'm pretty sure they didn't fall asleep because we're all on our edge of our seats. Usually realtors are when it comes to taxes.
I know, but it's just un-American to pay more taxes than you have to. But yeah, I mean it's just there again. Just have a game plan. Yeah, and if anybody's interested, yeah, probably can shoot out my information. Love to have a little chat, see if we can help.
Okay, awesome. Thank you so much, Drew.
You're welcome.
Yes, thank you for fitting us in your schedule. We appreciate it.
You're welcome. I'm glad I can help.
All right. Have a great day.
Appreciate it.
Bye.
Thank you.
Thank you.